The cursor hovers over flatten. Price coils beneath VWAP. 5 1-minute candlesticks tapping it like a ceiling fan. Level 2 flashes bids lifting, then a refreshed wall at the offer, and your P&L blips green. Your entry is clean. Textbook setup. Opening drive. Pull back to VWAP. A higher low on the 1 minute. Confirmation from Delta on order flow. RSI easing on the 3 minute. Your stop loss sits beneath the pivot. You whisper, hold. Then a tiny red candle prints. The blip shrinks. Your thumb slides toward the exit, like it has a mind of its own. You tell yourself you're prudent. You tell yourself you can re-enter. You tell yourself protecting the position is discipline. But the tape shows bids stepping, wicks closing above, and the next liquidity pocket sits $1 higher. Still, the fear of giving back unrealized gains swells louder than the structure on the chart. 2 clicks later, you're flat. Seconds later, price surges from VWAP and runs. It isn't the setup that failed, it's the program inside you that hates uncertainty and loves quick relief. Loss aversion doesn't announce itself, it disguises itself as prudence and risk control. Inside the trader's head, the dopaminergic circuit fires at each green uptick, promising relief if you end the uncertainty now. At the same time, cortisol spikes at the first red flicker, magnifying the imagined pain of a normal pullback. Premature exits are rarely about charts. They are about neurochemistry misread as logic. Mark Douglas explained that markets present unlimited potential for both profit and loss. So the mind tries to reduce unlimited feelings by engineering certainty, flattening. When your goal shifts from executing the plan to protecting a feeling, your edge dissolves. Brett Steenbarger points out that in performance contexts, our attention narrows around the threat. At VWAP, the threat is the next candle against you. You become glued to P&L, deaf to the auction. Mirror neurons make it worse. Watch a chat room panic at VWAP, and you will feel their fear in your own hands. Scan enough social feeds, and you start copying exits you never planned. Meanwhile, the paradox multiplies. The best VWAP trades often feel most uncomfortable because they're buying back into value while momentum looks tired. More indicators can make it worse. More analysis at the line often equals worse results. As conflicting signals give your fear a perfect excuse to be safe. The line becomes a magnet for bias. Chart pattern hallucination creeps in. See one micro double top, and you believe a major reversal is starting. Add a tight trailing stop under each wiggle, and you guarantee bigger losses via repeated whipsaws. Douglas warned that fear distorts perception. You literally see the market through the lens of pain avoidance. That's why you cut winners the moment they wobble and let losers breathe a little more room. Your belief system is fighting price, not following it. Traders say VWAP is the fair price. That fair frame seduces you into thinking price must revert quickly, so any stall above the line feels overextended. But auction theory says value is accepted by time and volume. If bids keep stepping in and volume builds above VWAP, value is shifting. Exiting because of a red candle ignores the structure. Steenbarger's Trading Psychology 2.0 reframes the task: build processes that adapt. If the regime is mean reverting, VWAP tags fade. If the regime is trending, VWAP reclaims ride. Most traders don't adapt. They memorize one feeling, take the win, and apply it in all regimes. From market wizards, we learn that pros survive by letting the market pay them, not their emotions. Look closely and you'll notice the common loop. Entry hesitation at the first reclaim, then overcompensation with a late chase, then an early exit the moment VWAP dips, then revenge trading to earn back the miss. The loop repeats until your edge is gone. Break it by replacing feelings with rules at VWAP, rules you trust more than instinct to grab now. Here's the pattern that quietly drains expectancy at VWAP. You take a long on a reclaim after the opening drive. The plan is clear. Risk below the higher low, partial at opening range high, trail the rest behind rising structure, or below VWAP as it stair steps. The first counter candle prints, and you slide the stop to break even just to be safe. Price wicks down, tags your new stop by 2 cents, then immediately reclaims and runs. You log a 0 and call it smart risk control. But across a month, a string of zeros is a string of missed R multiples the math that was supposed to pay your drawdowns. Next variation. You take partial too soon. At the first 5-cent pop, you sell half, telling yourself you'll let the rest ride. Now your brain anchors to the smaller remaining size. When the next red candle appears, you flatten it all. Average winner, tiny. Average loser, full. Risk-reward collapses, not because the setup lacks edge, but because your exit logic rewards relief over structure. Another common twist, you use a dynamic trailing stop that hugs the 1-minute lows. In a VWAP grind, noise is price. The trail clips you repeatedly, converting a trend day into 4 scratches and a late chase. And when you finally widen the stop to survive noise, you do it on the worst one, right before the failed reclaim, turning a contained 1R loss into a larger hit. Every choice is driven by the same bias. Loss aversion, overweighting the immediate pain of a wiggle against you relative to the future gain. If the trend continues, the solution won't be found in an oscillator. It lives in codified VWAP exits, insulated from the swirl of emotion during holds, consistently. Marcus is the risk manager. He thinks in R, not dollars. Risk defines the trade, he mutters, aligning his chair so his posture stays tall when the tape speeds up. His TradingView workspace is boring by design. 1 minute for execution, 3 minute for structure, 15 minute for bias, VWAP, opening range lines, a 20-period EMA, and a session volume profile. On a side monitor, he keeps level 2 and time and sales, plus a footprint showing delta at price. Pre-market, he writes 3 scenarios for his names: trend day up, range day, trend day down, and how VWAP should behave in each. He marks prior day value area, single prints, and liquidity shelves where trapped traders might puke into his targets. He sets a daily loss cap and a max number of trades. He disables the floating P&L on his execution ladder. Before the open, he breathes. 4 seconds in, 6 out, repeating until his chest stops humming. He reviews the exit script out loud. Partial at ORH only if 3-minute structure remains intact. Remainder trails under higher lows or a clean break of VWAP with acceptance below. No break-even stop unless structure breaks. His goal's not to be right. It is to express the setup's risk-reward without his fear editing the play. On losing trades, he never removes the stop loss. On winners, he never moves it to an arbitrary whole number. When volatility spikes, he cuts size in half and widens stops to the actual swing point so noise doesn't decide his fate. During entries, he watches the tape, but during holds, he watches the structure. If he feels the urge to just take it, he looks away from the 1 minute and checks the 15. Has value moved? Is VWAP bending up with time above? If the answer is yes, he returns to the rule. Exits are structural, not emotional. He has failed enough to respect the paradoxes. Tighter stops can increase losses, more screens can reduce clarity, and the best trades often feel worse to hold. He remembers market wizards' lessons. The pros survive by aligning size and exits with their edge, not with their mood. He knows slips happen. He tags the chart where emotion hijacked him and writes a rule to close that gap. Rewiring premature exits at VWAP starts with a contract between you and your future self. Write the exit plan before the bell, print it, and tape it beside the monitor. The plan defines 3 elements for each setup: structural stop, scale-out logic, and invalidation. Structural stop, below the pivot that proves the reclaim, not at break-even. Scale-out logic, partial only at predefined targets that map to structure opening range edges, prior day value edges, and volume shelves. Invalidation, acceptance back below VWAP after a reclaim, demonstrated by 2 closes and continued selling on the tape. Then make the rules runnable. Program hotkeys or bracket orders so your default stop and targets populate instantly. You can move them only in the direction of more risk toward reward, never toward relief. Hide the floating P&L. Replace it with a tiny label showing R, multiple and distance to structure. Use a walkaway timer. After entry, step back for 60 seconds to let the first pullback play. Your job is to observe structure, not your heartbeat. Breathing matters. 4 in, 6 out when red shows. It engages the brake pedal of your nervous system so your cortex can read the auction. Journal in real time with checkboxes, not paragraphs. Did price accept above VWAP? Did delta confirm? Is the higher low intact? Each box you tick becomes a reason to hold. Set a maximum of 2 partials. The first feeds the emotional need for progress. The second is at the day's structural target. Never scale out, just because it's stalled. If price stalls without invalidation, tighten using structure. Move the stop under the latest higher low once the next one forms. Don't trail candle to candle. Size solves feelings. Predefine a small risk ladder, 0.25R, for first touch reclaims, 0.5R for reclaim plus higher low, 0.75 when reclaim, higher low, an opening range breaker line. Small size buys patience. Build a personal VWAP playbook, 10 annotated screenshots of perfect reclaims and 10 of failed ones. Before the open, rehearse them, visualize the uncomfortable hold and your rule-based exit. After the close, do a brief metrics check. Average winner in VWAP trades versus average loser. If the mean winner isn't at least 1.8R, your exits are cutting the edge. Adjust the plan, not the chart colors. Every Friday, run a micro experiment. For the first trade only, forbid a break-even stop and require structure-based trailing. Collect 20 samples. Let the data, not the mood, rewire your instincts. Run the play for a month. Let size, structure, and statistics, not feelings, decide exits with calm consistency every day. That is how loss aversion finally loses its grip at VWAP, sustainably. Picture tomorrow's session. The open drives, fades, and coils at VWAP. You have your plan taped to the bezel. You define risk beneath the higher low. You enter on the reclaim. Bracket populates automatically. P&L stays hidden. A red candle prints. You inhale 4, exhale 6, eyes on structure. Wicks close above the line. Bids step up. Volume holds. You do nothing. At opening range high, you take the planned partial and say nothing to yourself except next target. The rest rides under higher lows. VWAP bends upward as time holds above. You trail to the next clear pivot only when it forms. The second target prints near a prior value shelf. You exit by rule, not because it feels toppy. Later, a reclaim fails. Acceptance slips below VWAP with selling pressure. You stop out at 1R and move on. The day ends with 2 trades. One structured winner, large enough to pay for inevitable losses. One clean loss that never threatened your day. You close the platform calm, trusting exits instead of chasing certainty at VWAP consistently today.